And Gary Wagner brings us into the weekend. He joins us this Friday. Gary, good to be back with you.
Great to see you again. Great to see all the Chartist viewers.
Now, Gary, the big event of the week was really the FOMC, and before the meeting, gold was consolidating in a narrow range. How do we see it set up now post-FOMC?
Well, one thing that we saw was that the economy in the U.S. is on track. And as such, Yellen has really maintained some transparency in saying that she's going to keep interest rates low. And of course, inexpensive money to borrow and invest will continue to draw more investors into the equities markets in terms of a best return scenario. I see current support in gold at about 1,200, and it really wouldn't surprise me if the market either went to 1,200 or 1,180 and bounced from there.
Now, Gary, we're really in the last push towards year end. Is gold acting the same way as it was last year? Are there any similar patterns?
Well, we have different circumstances, but the one thing that we have noticed that is similar is that we had, in essence, a decline over the last 3 months last year as it went to the second occurrence of 1180 at the end of December.
Great, Gary. And we've had analysts on who've also said we could see gold hit 1120 as early as November. Do you see anything in your charts?
Well, according to the technical studies that I've done, 1180 is that double bottom. We haven't breached that in years. And so to me, that's really unknown territory. I wouldn't be surprised if the market does continue under pressure and does break 1,200 to find some support between 1180 and 1,200. I would look for a little bounce there.
All right, Gary, on that note, we spoke about when the next gold rally would be last week. What have you brought us this week?
Well, what we want to talk about is the current models that we're looking at and realize that the most recent decline in gold is coming in tandem with the equities markets going to record highs and the dollar just as a runaway freight train. And so what we're going to explore is look at a couple of different pairings. The US dollar and gold is what we traditionally look at, but we're going to pull up a euro dollar gold to see the distinction between the effect of the US dollar on gold and actual selling in the market, pure selling or buying.
Fantastic, Gary. On that note, let's pull up your segment.
Over the last couple of months on our chart this series, we have been looking at gold prices and really paying attention to the fact that we had an absolute narrowing of range. And that narrowing of range in terms of characteristics was the fact that the highs were moving down, so we had lower highs and higher lows. Now, as long as you're in that type of scenario, there is no real evidence that you have a defined uptrend or a defined downtrend because you're not getting either a higher high, which would signal an uptrend, or a lower low. In the absence of that, and with the ranges compressing, the theory behind it is once you get to the apex of the triangle or you get a break above or below, there's a major release in energy, and that energy is going to convert into fast action in terms of price movement. We certainly saw that over the last couple of weeks. The other thing that is absolutely noteworthy and a game changer as far as I'm concerned is the fact that we have now made a lower low from the previous low. So we have actually broken out of this defined range and I believe could easily head lower still. So how low could gold prices actually go? Well, there's actually two parameters that I'm going to be looking at. The first one is the technical aspects of the market, and that is our current support levels. Century marks should provide some support if the market does continue to trade under pressure into this area. We've had an intraday low of about 12.16. We're recording this Thursday night, just after word has come out that the referendum in Scotland has not passed. It's not official, but they are mathematically certain of that outcome. And so we're seeing some continued pressure in the precious metals as we see not only the S&P futures moving higher, but the dollar moving back up after retracing on today's trading activity, meaning Thursday. Also, you can see here we have the stock market at record highs. Dow Jones Industrial Average, new record high. Standard & Poor's 500, new record high. So as long as we see these trends intact, in other words, a strong dollar and a strong equities markets, we are going to have a reciprocal pressure that is being placed on gold. If these trends, meaning the stronger equity, stronger dollar, continue, I would look for gold prices to test $1,200 per ounce. All things being equal again, I believe we could easily test and have a triple bottom forming at 1180 somewhere towards the end of the year. I'm really excited about the fact that next week on the 24th of September, Wednesday at 4:30 Eastern Standard Time, I will be doing a live webinar, and that webinar will be about an hour in length, and during that time, we will be able to look at our current models and really extract some detail and also look a little bit into 2015. Hopefully, we'll see you on Wednesday. Simply go to our website, thegoldforecast.com. On that page, you'll see a link. If you click that link, it will allow you to register for Wednesday's webinar.
Gary, as always, thank you so much.
My pleasure as always, and I want to wish all of our Chart This viewers a great weekend and prosperous investing and trading next week. We'll talk to you real soon.
And thanks for watching this edition of Chart This with Gary Wagner. The Kitco News team will be headed to New York City this weekend to start coverage of the Clinton Global Initiative, so be sure to tune in next week for coverage from the conference. In the meantime, you can email us at newsfeedback@kitco.com. Thanks for watching.